here come the first rates then on the screens right now. And we've managed to defend that 19,500 print for now at least, but let's see where it's going to head in and whether it's going to only worsen from here or not. And seems like it's getting pretty close to testing that 19,500 print for the Nifty 50. Similar move for the Sensex as well, down about 0.7%. And you're seeing quite a bit of red actually across the screen as we speak right now. Asian Paints, Tata Steel, ONGC, Adani Enterprises, Adani Ports, SBI down 1.5%, NTPC, quite a bit of red in there. Let's talk about the stocks in news then this morning, and Reliance Industries, considering ADIA is looking to invest into Reliance Retail for that 0.5% stake. 0.7% lower for Reliance, which is now, by the way, about to even reach 2,300, and I think this is going to happen after a while. TCS, let's see what that stock is up to. I think it was in the red. Those are the first ticks on TCS. No, 0.5% higher, 36.37 on that stock, ahead of its numbers in buyback tomorrow. ONGC, crude surge, Brent back to $90 per barrel on the West Asia conflict. About 1.5% is the uptick that you see on ONGC. Titan as well, positive news flow there after the second quarterly numbers. Both the jewelry as well as the eye care businesses are looking robust. 1% lower for Titan, not really seeing any cheer there. What about MCX? That has also come out. SEBI panel has approved shifting to a new platform. MCX holds up about 1.25% in an otherwise weak market. Positive management commentary from both Metropolis as well as Prestige in their Q2 updates. So look out for what both these stocks as well do. And then, of course, there's RVNL as well, which has, got a LOA from the Mumbai Metro for a project worth about 395 odd crore rupees. 4% is the gap down that you're seeing on RVNL. What about Tata Steel? I think that started off in the red, considering the India business delivery is down nearly about 2%, and Europe delivery has also slipped 4% on a year-on-year basis, 2.5% lower for Tata Steel as we speak right now. The big mover from last week, let's see what Bajaj Finance is up to after that fundraising, and then in the run-up to that as well. Bajaj Finance takes a breather at 81.20 as we speak right now. ICICI Bank, Infosys, HDFC Bank, just want to revisit all these rates. 0.5% lower for ICICI Bank, Infi marginally higher, and then HDFC Bank down 1% once again. Kunal, what's it looking like? Seems like we're already headed into breach 19,500. What would it mean?
Yeah, I think it could again mean that we are back below that 50-day moving average for the Nifty, and that could, I think, dent the immediate prospects for the market. So, not a great opening for the indices. There's got to be more selling pressure across the board, especially for the stocks which have been showing signs of recovery over the last couple of days, and specifically the last 3 days of the market recovery. In terms of the opening trade, DLF is something which looks attractive. So the stock from the real estate pack looks quite charged up. So we'll wait out for some mild corrections into the stock price to buy into the dip.
All right, there you have it. That's a buy recommendation coming in on DLF. And a quick check-in on the broader universe as well. And it looks like that underperformance is pretty evident this morning. It's a sharper cut as compared to the frontline indices in excess of 1%. Let's get on board then. Vetri Subramaniam, who's joining in on the show. He is a CIO at UTI AMC. Vetri, so good to have you. Thanks so much for joining in. And it seems like in the conversations as well in the past with a lot of market experts, they were alluding to the fact that if at all there were to be a sort of change in the undertone of the market, that would largely be led by global events or global developments. Do you think what we're seeing play out right now warrants, a sort of a decisive change in the market sentiment?
I'm not sure everybody has managed to figure out the, geopolitical implications of whatever has happened over the last 3 days in the Middle East and what that could actually mean for markets. But I think, the bigger sort of trend and is obviously that this is something which could create a fresh round of instability. We already have one conflict in Europe. Adding conflict to that in the Middle East doesn't really create anything good, so nothing good is going to come out of it, is the way we would look at it. And I think the larger issue remains one of the fact that, both in an Indian context as well, we had the monetary policy last week where clearly they continue to sort of reiterate their desire to keep things slightly tight. And in the US, you had a phenomenal jobs number on Friday, which once again sort of, raises concerns that could be perhaps even one more rate hike in the US. And certainly the plank of, higher rates for longer is becoming very, very, sort of something that the markets will have to deal with. And I think all of that doesn't bode well for valuations. Neither does it particularly bode well for earnings, because you're then talking about rates consistently being higher. So to my mind, that's sort of the panoply of, challenges that we face at this point of time.
Having said all of that, Vetri, you think, India is already buying discounted crude from Russia. Macros, how the domestic flows have been. You think any blow, if at all this were to worsen, will cushion India and we continue to remain a buy on dips market?
I think let's just step back for a moment. Clearly India is in a reasonably good place, and that's because of some of the sound macroeconomic policies we've followed over the last few years, particularly post-pandemic. And that's resulted in the fact that we've come out over this period with a fiscal which, was hurt, but is starting to heal. It's at least moving in the right direction. The current account deficit is well within control. So a lot of our macro parameters continue to remain I would say in a very comfortable zone. And that would therefore place India in a reasonably, competitive, in a very good situation compared to the challenges that some other economies are facing. But having said that, it's not that valuations are, bargain basement cheap at this point of time. We don't do any, we don't look at the importance of valuations when we very simplistically look at buy the dip. Where are valuations relative to the historical cycle? I would say actually large cap valuations are sort of more in the fair value zone, though above the long-term average. But there are parts of the markets where valuations are challenging. And therefore, I would say buy the dip is too simplistic an approach in areas where valuations are challenging.
What about the kind of fervor that we're seeing play out when it comes to the entire, manufacturing space? There seems to be a lot of expectations riding high within this sector. Is that likely to play out well, according to you? And how would you be betting on that from a stock market perspective?
I think certainly this is an area where not only government policy, but equally just geopolitics is playing a role in terms of perhaps allowing Indian manufacturing sector to get a leg up, something that it has not managed to do in the past. But, I always worry about valuations because, we've seen this before when stocks do extremely well and they put up the valuations. What are they actually doing? They are actually discounting the earnings that these companies can deliver in the future. And if you pull too much of that into the valuation, you actually depress your forward returns. So, that's my concern when we look at things like some of these manufacturing themes. Now, there could be one or two companies which still manage to pull it off. But when I see a generalized tendency for the whole sort of sector or an array of companies to start discounting a very rosy future, this to my mind has always been a precursor to the fact that future returns have been pulled into the present, and therefore the future returns actually get compromised. And those high valuations, go back, look at infrastructure 2007, even go back and look at how the IT sector was trading in 2020, 2021, when everybody said the whole world is tech. Look at the valuations they got, and then it's been a gradual descent down in terms of valuation. So that's my concern when we talk about this manufacturing opportunity. It may play out in the economy. I worry that the stock market has discounted it way too early.
Yeah, seems to be the case. Vetri, since you did highlight IT, just wanted to understand, given that this week we're going to officially kickstart the earnings season, TCS is now going to mull a buyback as well tomorrow. What's the expectation here? Even as we speak, the stock have already made it, to their 52-week highs, most of them.
So, the IT sector is one sector which hasn't needed a crutch, or at least hasn't needed a crutch in the last 10, 15 years in terms of policy support, globally competitive businesses. So the only question as an investor you've got to ask yourself is, are the valuations right? And B, of course, because this is a sector which is, driven a lot more by external demand, the health of the global economy and particularly the US economy becomes very, very critical to, judging the attractiveness of the sector. Now, bottom up, as I said, this is an area with multiple companies, all globally competitive in their right. We certainly like that area. But, my approach toward this would actually come back to something you said earlier. I'd wait for those dips because these stocks having coming to up to 52-week highs is actually, to my mind, not making it to be a particularly attractive entry opportunity. My sense is macro commentary out of the US will continue to remain slightly challenged, particularly because our companies have a big exposure to the banking and financial services sector. And, if bad news comes along, I'll be happy if the stocks dip to go in and buy them. So long term, these are a brilliant set of companies, but, I'd like to have valuation comfort before I get into them.
What explains the underperformance in the large private banking names?
Yeah, that's been a bit of a surprise because, I would say valuations there are mid-cycle. The businesses are doing fabulously. Maybe the market's, sort of given a bid up to some of the other banks, which don't necessarily have very strong outcomes in terms of return on assets. But, what we've seen through this last 2 years has been a pattern in which credit costs have come in much lower than what people were anticipating. Recoveries have been fairly good. So I would actually say financial lending companies and banks who typically have had much poorer return on asset outcomes over an entire cycle have actually seen a very strong bid in the market simply because they were trading perhaps very, very cheap. But when you look at them through the entire cycle, these would not really be the preferred companies that we would want to back. So large banks have been disappointing, but I do think the top 5 or 6 lending institutions in this country, their incremental market share is now close to almost 2/3 of incremental deposits and loans. And I think that's the place I would be very happy to back.
Vetri, if one looks at the importance of election cycles, there is one in India next year followed by one in US after that. What happens to market because of these election cycles? Because we know that these are swing events. They are not binary events, but these are swing events.
Nikunj, I would say we need to, step back. I mean, look at 30 years, I started my career in 1992, 1991 was liberalization. Honestly, if you go and try to crunch the data to see which government did the markets do better or worse, do it. You'll find that it's quite surprising. There isn't really a very clear pattern one can discern. To my mind, the reason why India has remained a good investment destination for the last 30 years, remember the 20-year return on the Nifty as we speak today, Nikunj, is running at something like about 16 to 17% CAGR, including dividends. Spectacular, right? And multiple political regimes, multiple governments. I think what makes the Indian story sound is we've got this set of, good entrepreneurs who run sound enterprises. Intrinsic growth in the economy is good. And as far as government is concerned, each one of them maybe at a very different pace, maybe they've targeted different areas. The reform agenda has always moved forward. There have never been dramatic U-turns in policy in terms of one political regime throwing out something that the previous regime brought along. So to my mind, that gives a lot of stability. It's never as rapid as we would want it to be. People look at China and say, oh, look, they can take any decision they want in terms of policy. Of course they can. They're not a democracy. But if you're a democracy, I think what gives the Indian growth story remarkable stability is the fact that it's always onward and forward without any dramatic U-turn in policy. And if you're an equity market investor, I think that's something that you should actually value quite significantly.
Okay. Vetri, where do you see this market in a sense is getting blinded with the current price action? I mean, is it defense, is it railways, is it power? I mean, I just get a sense that markets are getting blinded, aren't they?
But I'm on the same page as you over there. I think some of these areas, as I said, future earnings are now, to my mind, pretty well discounted in the prices. The last 2 years, Nikunj, have been intensely rotational, right? I mean, I'm used to rotational markets, but the last 2 years, the rotation has been absolutely berserk. I can remember late 21 when IT was, the toast of town. There was a period where steel and metals were the toast of town. Then you rotated into something else. Then consumer discretionary went out of fashion. Then people cottoned down to railway and, some of these PSU trades. So it's been intensely rotational. And to my mind, that in itself is actually a risk, because what we've seen is that after 6 to 12 months, each of these cycles actually tends to run out of steam. So I'm with you on this risk. And the valuations anyway make it slightly perplexing to take a call in some of those areas.
Assume that the next 1 year interest rates, they don't go down globally in a meaningful manner. India also just here or there. They don't go up, they don't go down. So what happens to the markets then?
Sorry, Nikunj, I didn't get that
No,
question.
I'm saying next 1 year, next 12 to 18 months, let's assume that interest rates, they stay where they are. They don't go up in a meaningful manner. They don't go down in a meaningful manner. So what happens to the underlying valuation matrix?
Good question. A precursor to that would be just to look at recent history. October 21, we are now in October 23. The Nifty has done nothing over 2 years. It's like 2% CAGR. Now, there have been some segments of the market which have gone ballistic during this period, but we'll see what happens to them somewhere down the road. They could, sort of do catch-ups. But the reason why the Nifty is only about a 2-3% CAGR over 2-year period is simply because the starting valuations have become extreme. The good thing about today, as far as large caps are concerned, Nikunj, is that while they are above average, they're not blinking red. So, I would say use the next year or two, even if rates are high, to build your core exposure in those large caps. I think that's where the valuation opportunity, to my mind, is slightly more comfortable. It's not bargain basement. It's not March 20. It's not the middle of 2013. It's certainly not March 2009. We're closer to all-time high than we are to a 52-week low. 52-week lows are the time where you really get aggressive in terms of saying, should I take up my exposure to equities? And then, of course, we should also look at valuations. But today you're closer to a 52-week high. So, it is what it is.
In the light of where right now China is moving, how would you position, or how should one position themselves in commodities?
Interesting question. When I look at it bottom up, actually, the valuations to my mind now give us a fair bit of comfort. Now, in the past, metal cycle stocks have tended to go much lower than their current valuations, well below one-time book. But I think what makes the current picture slightly different is that the debt on the books of many of our leading metal companies is not as high as it used to be in the past. So I do think the floor is now closer to maybe one-time book rather than half-time book, which it used to be in the past. The valuations give great comfort. You're absolutely right. I can't see China sort of reporting any sort of gangbuster growth, and therefore that's not going to be a leg up for commodities. But the valuation comfort is there, and that's good enough for me to take a chance. I think as far as China is concerned, the other thing that we need to keep in mind, Nikunj, is look, they're pulling off a transition in their growth model. And I think one of the things you'll see as part of that growth model, they've already talked about this, the demand for steel and aluminum may well come down over the next few years in China, but because they're sort of looking to grow in a manner which is less harmful to the environment, improving the quality of life of their citizens is a stated agenda of, Xi Jinping thought. They've also talked about shutting down large portions of capacity. So to my mind, the global equation may still remain reasonably balanced, even though China may not be a source of demand, because China will simultaneously curtail capacity.
Sure. Vetri, great to have you on the show today and get in all those insights.
Thank you so much.
Okay, let's move on and let's throw focus. Actually, before anything else, let's just revisit where the market is settling in at. Because from getting pretty close to breaching that 19,500 mark, you've seen quite a bit of rebound actually come in from there. We're back at 19,542, and that's almost a 0.5% recovery. While yes, names like JMR Infra, Adani Ports, Interglobe Aviation, HPCL, PNB are all down, but a big uptake on an MCX, which is now up 3%. HCL Technologies up 1.5%. Metropolis, UBL, Divi's Labs, Infi TCS marginal uptick coming in there. So sectorally, it's IT, which is sort of resilient in an otherwise weak market today. But let's try and figure out what's the trend really emerging from banking and financial services. Nitin Agarwal joins in on the show right now to talk about exactly that. Nitin, hi, morning. Good to have you on the show. Just looking at the trend that's been emerging across the second quarter updates, right, wherein the loan growth has been strong. What's really stood out for you amidst the Q2 updates that have come in?
Yeah, hi, good morning. Thanks for inviting me. So yes, this is going to be another steady quarter, what we are looking at in terms of earnings. While first quarter was exceptionally strong and more so for PSU Bank, which reported collectively more than 100% growth. And we know for a fact that margins over the year are going to moderate. We have already seen the cycle turning in the first quarter, and which is where the earnings will also begin to moderate as you go forward in the year. But at least for second quarter, we are still looking at it over 25% earning growth for the sector, and that is adjusted for HDFC merger. And so private banks therefore are going to report over 25% growth, and PSUs will also be close by somewhere in the 20s. And this will be driven by a combination of steady loan growth, what we are looking at. And while margins will moderate this quarter again, but that will get balanced by the further improvement in the provisioning for these banks.
If HDFC is talking about a credit growth, and this is the last number which came out a couple of days ago, the quarterly update, they are talking about a credit growth north of 20%, 23 to 24%. So can we safely assume that for mid-tier it would be at least 30% plus?
Sorry, mid-year you were saying 30% plus?
Mid-tier, yeah.
Mid-tier. Okay. So I think cannot really extrapolate, I think, like that, because if you look at some of the mid-cap banks and mid-sized banks have already reported the business update, and the performance has been still mixed over there. Within the key names that we cover, if you look at Federal Bank has reported close to 5% sequential growth. So that's very similar to where HDFC Bank is. And where the growth momentum will remain healthy. We are looking at a 14 to 15% credit growth for FY24, and again around 14% number in FY25 is what we are working with in our estimates. And I think these private banks, the range can be between 17 to 20% as of now what we are looking at. Very few banks like say Equitas or AU will be doing a number which will be going to be higher than that in terms of the growth range that we have.
Do you see the war of liability, which in a sense has been a constant feature for banks, having impact on the NIMs further?
That is a possibility, yes, and it cannot be ruled out because we are seeing very intense competition for deposits across banks. The CD ratio for banks and as a result for the system now has increased sharply. I think looking at how the recent events have panned out, which has further sort of resulted in up the bond yields, and any possibility of rate cut that we were looking at later during the year is getting deferred a bit, and which is where the rates can remain elevated for slightly longer than what they otherwise could have been, and which is where I think the funding costs can continue to inch up over the year, and margins therefore may report a downtick over the coming quarters.
Nitin,
that possibility of a competition for liabilities is very much there.
Sure. Nitin, I want to talk about some of these large private banks, right, and the recent spate of underperformance that we've seen pretty much across the board. Now, HDFC Bank has, loan growth and deposits, actually a decent uptick coming in the second quarter number. What is the concern then for the market? What do they think is at risk? I mean, do they think that it cannot grow on such a large base and it will not really, multiply the same way as it did when it was a standalone entity, HDFC Bank?
Yeah, so certainly that has been one of the concern for the street. And while we have been optimistic in terms of the ability of the bank to execute, after all, they have been doing it for over 25 years. But just because post the merger, the size of the balance sheet has increased dramatically, and they need to therefore raise a lot of liabilities, both to retire the borrowings as well as to fund the growth. While Q2 has business update has given a comfort to market that the bank can execute at that scale, But I think investors will want to watch out the execution over the coming quarters before completely aligning with that view. Because historically, we have seen the bank doubling the balance sheet in close to 4 years. While the guidance on that from the management remains unchanged, and they're still looking to double the bank in the next 4 years broadly. But I think the execution in the coming quarters will be important. And this being the first quarter when the bank will be reporting the merged entity numbers. And we know that they will be reporting some compression on the margins to begin with, while the business growth numbers are out and they are very healthy. And but the recovery, therefore, on how margin pans out in the coming years will be important to assess a view as to how quickly bank can move back to the 2% ROA, which is where it was pre-merger.
Traditionally, you've always preferred PSBs and amongst the private players, ICICI Bank. Has that really changed? And do you see value on the table in any other names too?
I think yes, PSBs, we have been going pretty positive over the last couple of years. We upgraded Bob in 2021, mid-21 at around 80 rupees. And the entire pack overall, if you look at, has done quite well. And that, I think, while you will see consolidation in these PSBs time and again, but the broader underlying fact that the ROAs are going to sustain at 1 and they will possibly move up in the near term or probably over FY24 and 25. And which is why the sector has been very resilient and they keep bouncing back after every round of consolidation. And now that we are looking at broadly around 17% average ROE PSBs, over FY24, 25, and multiples still look to be like most of them are still below 1 in terms of the price to book multiples. And that leaves still a scope for further re-rating in these banks. And we continue to like the top names like SBI, Bob, and Canara in PSBs.
What about some of the payment companies, the likes of a Paytm or an SBI Cards? How do you think one should be looking at them in terms of the overall valuation metric as well, the earnings-based valuations?
Yeah. So yeah, we covered both the names, and SBI Card has been like over the last couple of years, the performance has been a bit subdued, and that's primarily because the revolve rate for the entire industry has come down, and margin for SBI Card has moved down considerably from what it used to be. And now that the funding cost is looking to get stabilized and incrementally, possibly from Q3 and Q4, you will see gradually NIMs begin to expand on a more calibrated rate. And on the asset quality side, there has been some uneven performance. Last quarter also we saw an uptick, and which company attributed to the specific cohort. I think as these issues get sorted and the credit cost begins to recede, you can see a stronger earnings growth, and that will get reflected in the stock multiples on SBI Card. So we like the company, but I think it will be another sort of a range-bound performance in the very near term, and thereafter it can do well, backed by the stronger earnings growth in FY25 is what we look at. And Paytm, another company that we initiated in April. So the stock has done quite well. It's almost a 50% since our IC. And I think going forward, while the metrics are, of course, tracking well, we are seeing a stronger run rate on devices, on MTUs, and even the GMVs, and the loan disbursements. All these metrics are tracking well. But of the recent, the regulatory concern on some bit on the personal loans and the unsecured loans, which the governor also talked about in the recent policy meet. And so that has been a bit overhang on the overall growth rate in the sector overall. But otherwise, I think the company is on track to achieve a bit of break-even in FY25 by the second half of FY25. So which is going to continue to like the company from a long term.
Okay, and what about your outlook when it comes to some of the life insurers, given that it is an environment where there is quite a bit of competition too, with the savings products, rates to have gone up substantially? What's your outlook?
Yeah, I think life insurance sector has seen some bit of pain around the budget time when the government changed the rules for the high ticket policies in terms of taxation. And the sector has seen a recovery in terms of growth, and mainly in the second quarter. And this quarter, we are looking at a relatively better AP growth and feeding into the VNB growth. While the margins, we are not expecting that to be a driver of VNB anymore, but we see that steady premium growth, because the overall the sector is still quite underpenetrated. And the new product lines which are going to build up and expand is going to drive the growth for the sector over the next many years. And which is where there is a structural story in the insurance. and therefore the VNB growth can sustain around 18%. And some of them are trading quite compelling in terms of valuations because the ROEVs are very steady, closer to 20 or 20 plus also for some companies. And this quarter in particular, there could be an EV uptick because of the entire market movement that we have seen. So we like the space overall, and SBI Life is the top pick for us in the space.
All right, thank you so much for joining in and giving us an all-round view on how things are shaping up within the entire banking and financial space. A quick check-in on the index, and for now holding out around the 19,550 mark, actually just at that level as we speak. 328 points down on the Sensex, but it's the markets that are seeing deeper cuts. Let's get you an ET Now exclusive then, and we're learning from sources that Escorts is looking to exit their railway business. Let's get in details on the valuation, the timeline and the game plan. We've got Somit here with those exclusive details. Somit?
So what we're understanding from our sources is the fact that Escorts is looking to completely exit its railway equipment business, and the valuation that they're eyeing from this divestment is close to 4,000 crore rupees, which is nearly 14 to 15% of Escorts' current market capitalization, which stands at close to 35,000 odd crore rupees. Now the reason for Escort to completely exit from the railway business is the fact that railway has always been a non-core business of Escorts, and even post the takeover by Kubota, they are now looking to expand that tractor business. In fact, the stake sale or the proceeds that the company would receive from the stake sale would be utilized by the company for the expansion of the tractor business going forward. Now, the railway business currently contributes nearly 9% to the company's top line and 10% to the company's EBIT, and off late business performance has been strong on the back of higher export sales. Even in first quarter, the company won a new order related to electric panel business, and the order book of the railway business currently stands at close to 950 crore rupees. Over FY18 to FY23, if you see, the railway business revenue and EBIT have grown nearly 3x. Now, we also reached out to Escorts for a comment, and they denied to give any comment on this market speculation. But what we are understanding from our sources is the fact that the company is eyeing a valuation of 4,000 crore rupees and will be looking to completely exit from its railway equipment business going forward.
Thanks very much. The stock price holding out by about 0.5%. That's Escorts Kubota at about 32.09. Tell you what, we'll slip into a very quick break right here on the show, continuing all that market chatter when we return.
Okay, back with first trades right here in ET Now, and the first trades have actually covered quite a bit of ground. An immediate buy on that dip that came in when we got close to even breaching that 19,500 print. From there, a marked recovery coming in. What's leading the recovery is actually the surprising pack. It's IT ahead of its numbers this week itself. HCL Technologies is your big mover today. About 1.5% is the uptick that it's seeing. And then, of course, there's TCS, given that they're going to be mulling the buyback day after when they come out with their numbers. 36.67 on TCS as we speak right now, and that's a good move of about 1.25% coming in. Infy is holding up 1% right now. Tech M is higher by nearly 1%. And Pharma also is seeing some dots of green. So I can say at least about Divi's and DRL, that's where you are seeing some green ticks come in. Let's see how sustainable this move actually goes out to be. But let's move on and let's talk to the management of Ujjivan Small Finance Bank, and let's try and understand what makes them so upbeat about the second quarter. Itara Davis, the MD and CEO, joins in on the show right now. Mr. Davis, great to have you on the show. Just going through your quarterly updates and your disbursement momentum, tell me what segments are seeing growth, and does it look like a sustainable trend to you?
Hi, good morning, Aisha. It's good to be back with ET. It's a good trend. I mean, we started the year well, and we are continuing well. The whole economy is doing well, so that is helping us. But for us, we are seeing the biggest growth in this quarter, percentage-wise, has been in the affordable housing business, which has grown quite well. And, that is because we have put in place in the last 2 quarters very good infrastructure. We have reorganized the business. We have gone back to the drawing board, and all of that is helping to give considerable growth in the last quarter in terms of sectors. But of course, our traditional sector, which is microbanking, is also doing well. But the star of the show for the last quarter is the housing book.
Why is housing growing? Is there anything special which has happened that suddenly there is demand which has come in? Because nothing, frankly, has changed in last 6 months or 8 months that the housing demand should come back. And that's the data what you're sharing with us. It's industry-wise data. I mean, the housing demand has come back at the HFC level across industry now.
It's just come across industry, but we are now doing in terms of growth a little above what the industry or the other, small finance banks are doing in that segment. So, for us, that is the focus because we are also looking at growing the secured part of our book. And what is leading that secured growth is definitely housing. The other segments, secured books will also keep growing. We have gone back to the drawing board for all of these businesses, coming back with a revised product which has got solid loan operating system, loan management system. All of that will help us as we get into the next quarter. And all of this is in keeping with the growth of our branch network.
Now that we are getting a clear sense that interest rates are unlikely to move higher, yet bond yields have gone higher. Last Friday, after Reserve Bank of India policy meeting, the bond yields, I think, they were 12-month high or a 13-month high. What would be the implications of that in the near term? Because if you borrow from the wholesale market, that means cost also moves higher. Cost moves higher, then could it have an impact on the demand per se?
Yeah, I think, if interest rates keep moving up, there will be some adjustment in the demand segment. But for us, if you look at our numbers, our deposits have actually grown faster in this quarter than the loans, which is our preparation for a higher rate environment. So I think, we have anticipated that. We did that in the past, in the last year as well. And in this year, we expect that, the interest rate will either stay at these levels or be more on the, on the uptick if things remain the way they are, because it's a global trend and it's also slightly high levels of inflation. And we are seeing oil prices ticking up. Recent events globally are not going to help that either. So I think we have to be prepared for a higher interest rate. But if interest rates remain where they are for the rest of the year, that's fantastic. But the likelihood is more an uptick, whether this quarter or early next quarter.
Okay. What happens to the non-housing finance business, given that that's also the mainstay for for you?
Sorry, I couldn't hear you very well. Could you repeat that, please?
What happens to the non-housing finance business, especially the unsecured loan business now?
Yeah, the unsecured loan business is our traditional business, which is the micro banking or microfinance. Actually, what has happened in the last year, RBI has raised interest rates 2.5%. To this segment, our lending rate has gone up only 1%. We have actually absorbed 1.5% or whatever is the cost of funds we've had. And, we understand this segment is something that we need to protect, and we need to ensure that this segment is taken care of as much as possible. So, that is the situation today. But if interest rates go up, then we may have to look at an increase. That will be our last, option in terms of the lending rates. But we are also working on our cost-income ratio and all the others, and our funding part as well, our liquidity ratios. We are managing all of those to see whether we can defer or hopefully delay any lending rate increases. And if that is possible and the interest rate cycle changes early into the next financial year, then we are well positioned. So I think, we have to wait and watch. We are quite happy with the situation where it is. We are prepared for the next stages if it is on the upward trend. And I think, it's a good situation to be in right now.
As I see, your liability customers had contracted in the first quarter. Tell me how Q2 has shaped up and what's the trend that you see going forward?
Yeah, the second quarter has done well. Our liability growth has been 43%, which is perhaps one of the higher numbers in the industry. And that is a conscious decision which we took. We are consciously lowering our CD ratio. It is now around 91%. We'd like to see it below 90. and that is something that we are getting. We have launched a new product which is called Maxima. We are trying to drive the growth in the CASA through that product, and I think it's one of the most interesting products in the market today, and we are seeing good traction. So all around, we are looking at different variants on the deposit side, be it CASA or be it the time deposits or term deposits.
Okay. Comments. If one looks at the way the credit cycle is moving, the credit cycle, according to SBI, for them, they're a large bank, they've given a guidance of 13 to 15%. What, to your mind, could be a fair number for small banks to assume, given that if India's biggest bank is talking about a growth of 14 to 16%?
The small finance banks generally grow a little faster than the mainstream universal banks. I would say that this year, a number of 25% is not too far off. I would expect the 12 of us who are in the small finance bank industry to average around the 25% mark. Possibly some may be on the upside, some may be slightly less, but 25 is a good ballpark figure to have. It's slightly less than last year, but last year was a recovery year. So this year is a more stable environment. 25 is something that you can expect.
Right. Okay, Mr. Davis, great to have you on the show. Thank you so much for taking the time out.
Thank you, Aisha. Thank you.
Okay, let's take a very quick break. On that note, good recovery actually for the markets. We've covered pretty much all the lost ground thanks to IT. There's of course, some green within the broader market as well. So MCX has jumped up 3%. Metropolis is up 2%. There's UBL, which is up 2.5%, and Delta Corp is seeing some dead cat bounce. That stock also higher by 2% as we speak. Talk about the big movers today, and that's clearly MCX. It's an 18-hour news break, which is confirmed. We told you first. Back on September 26th, that SEBI has withdrawn its abeyance order and asked the company to propose the go-live date on the new platform. In fact, Sharad, who broke this story, joins in with more details.
Well, yes, it's an important development coming up for MCX as they have received approval from the tech panel of SEBI to actually go ahead with a new commodity derivatives platform. And do remember, this is an important update coming in because there was an important overhang coming in the stock because of the delay in the implementation of the new software. Now, the MCX is expected to intimate SEBI regarding the proposed date to go live for this new platform. And on 26 September, we had actually mentioned at ET Now that the company will be transitioning to the new software in the month of October. Also, the impact analysis, if you look at it, the shift of the new service will lead to lower costs coming in because almost 125 crore rupees per quarter of expenses were there because of the old software. Now, the stock is already up almost 55% of the May's lows itself and near its 52-week high levels. And the transitioning of the software, this will be handled by TCS and the software will be provided by them. So, an important development coming for MCX and it's expected a positive reaction.
Okay, we'll leave it at that. Sharad, good to have you on the show, and congratulations on that news break as well. But let's hear out some more market opinion. Here's Saurabh Mukherjee telling us what he's doing in his portfolio right now.
Free ticket that I've heard of is gone. Not only are tickets gone, hotels are rammed, plane tickets are booked out, and I think this goes to show how wealthy a certain strata of Indian society has become. I would say not just the Indian upper middle class, but in general, in the big 10 cities of our country, levels of affluence and disposable income have reached close to first world levels, which is why you're seeing ticket prices which are comparable, I would say, to say a football World Cup held in the Western world. So heartening to see this level of affluence in India's big city.
Absolutely, and one has seen that affluence rub off on all the data points as well that we've been getting off late, be the property registrations, be the auto sales, all of it. You think this premiumization theme, Saurabh, is here to stay for a long? Because a faction of the market also believes that what you could bet on right now is the rural recovery because they are the ones which have underperformed for the last over a year or so.
I think there are three underlying drivers of wealth for, I call it the octopus class, right? Roughly a million super rich individuals. Three underlying drivers. Firstly, obviously the stock market, right? The stock market's up nearly 18, 19x in the last 20 years. Anybody who's invested serious sums of money in the stock market over the last 20 years is on a rocket propelled ship. Secondly, as the country networks, roads, airlines, broadband, the India stack, even small businesses who are competitive, small businesses in small town India are locking into the broader national economy. And it's very interesting that in our small and mid cap portfolios, some of the best companies are no longer in the big 4 or 5 metros. They're in the next 20, 30 cities. And the rise of an integrated national economy is driving an SME class. And the third aspect, I think, is the rise of what I call global capability centers. We have roughly 1,600 GCCs in India. These are companies and these are global companies, India offices, but this is also, say, a Google or a Microsoft's programming centers in Hyderabad and Bangalore. Our reckoning is, Aisha, that this number is growing by 20% every year. Pretty much every day a GCC is opening up in India. That itself will create around 4-5 million jobs, affluent, high-income jobs. And this combination of the whole world's, not just IT services, but payroll, finance, marketing, audit, all of that work being done in India will create a deeper layer of affluence in Bombay, Bangalore, Hyderabad, Gurgaon, but also increasingly cities like Coimbatore, Nashik, Indore. These cities are becoming big hubs for global work. So three massive drivers of affluence for premium India. The lower income strata is a different story. I think the FMCG company struggles you were highlighting a few minutes ago tells that part of India is struggling. But upper middle class India, octopus India, as I call it, is absolutely booming.
Oh, yes, indeed. And even with the kind of inflated prices that we've seen for hotels, airlines, etc., not just for the World Cup, but people are really willing to shell it out for those great experiences. Which brings me, Saurabh, to just get in your quick take as well as to how you're looking at, say the food aggregator space or the entire consumption sector really getting a big pickup, of course, from a big event like this and, sort of sustaining that momentum. Do you think that that is looking achievable? Because, say, in 2019, it was the likes of a Jubilant that really took the lead when it came to a big event like the World Cup. But now it seems to be a lot of other players as well that are dominating this space.
So in the food aggregator space, I agree with you that there'll be a volume uptake is all but inevitable given the scale of the World Cup. But the challenge, I think, in food aggregation and generally in much of the digital space in India is bargaining power, is competitive advantages and the ability to translate volumes into profits and cash flows. I think that remains a struggle for food aggregators generally and the digital online space in our country. Where we think the biggest profits will be made is supplying the critical inputs which go into the food industry. So, for example, in our small and in our mid cap portfolios, Little Champs and Rising Giants, we are big shareholders in Fine Organics. Fine Organics supplies the emulsifiers, a significant number of the additives which go into biscuits and snacks that we have on a day-to-day basis. It goes into our fizzy drinks that we have on a day-to-day basis. That's where the big kicker come. Companies which have established almost dominant hammerlock into the raw materials which go into our foods. And if you see Fine Organics' return on capital, it's around the 35% mark, suggesting deep dominance of some of the essential inputs which go into the stuff that we eat on a day-to-day basis, our snacks and our fizzy drinks.
Okay, Saurabh, what about the entire chemical space and even pharma for that matter, the CDMO manufacturers, etc.? Which are the stocks you like there?
So I think what's been very interesting, this is the first time I've seen this in a long time. May, June, July, August, the Chinese really came after the Indian pharma, spec chem and agrochem industry. I haven't seen China come at India this aggressively since COVID. The RMB was devalued. The Chinese government gave subsidies. The Chinese government gave profit guarantees to Chinese exporters who were willing to take on the Indians and push through price cuts. So our reckoning is from May through August, China pushed through basically a 25% price cut on pharma, agrochem and spec chem. September is when the Chinese have thrown in the towel from what we can see. I think the second quarter results for the spec chem, agrochem, and the pharma industries will be affected by the Chinese price cuts. But September, the month of September, we've seen prices bottoming out, and I'm hopeful that when both the pharma companies and the spec chem, agrochem companies announce their results, they'll give us some sense as to why the Chinese threw in the towel in September and what we can expect to see on the prices front. My hope is the prices have bottomed out, and therefore I think the second half of the year will look good for many of our larger holdings. For example, we are large shareholders in Divi's Lab, in Alkyl Amines, in GMM Pfaudler, in Poshak, and we're hoping the second half of the year will bring good news as the price action seems to have bottomed out.
All right, let's move right on. Chartbuster ideas. Let's find out that in this market, what's looking good from our chartist standpoint. We've got Kunal joining right back. And Kunal, decode your first chart.
So, Avan, it's on NBCC and another PSU name which has actually started to show signs of strength as well as interesting chart pattern. So, what we are looking out for is the last 3 to 4 months price patterns for NBCC, and it's a very rare kind of a phenomena that you've seen the stock going into a very sharp uptrend in a very short span of time. So, the recent charts indicate that the stock formed a major bottom closer to this range around the 40 mark for itself. This came at a point when the stock went into a gradual correction. You can see the number of red bearish candles over here, for the stock forming over here, formed a bottom at current levels of 40, and then gradually when the stock started to move up higher, the first pace of rally was quite slow, steady for NBCC. So from 40, the stock took almost 1 month to move up to levels of 44, 45, which is a 10% jump for NBCC. But then the pace intensifies in the second stage of the rally, and the stock its base. So from 44, 45, the stock upped its base towards 47, and the recent low for the stock was around the 50 mark, as you can see from current levels. Now, interestingly, we come back into this zone of consolidation. So after a rally from 40 levels to approximately 60, which is a 50% jump for NBCC, the stock goes into a phase of consolidation. So in this phase of consolidation, it forms a pattern of lower highs for itself, but apparently it also makes a pattern of higher lows around the 50 mark and then 55 as a base. This, in technical parlance, we call it as a bullish pennant formation. Now, interestingly, the stock generally gets into a breakout after the steady uptrend as well as a consolidation. So we are looking out for a breakout closer to that 62 mark for NBCC, and once that happens, we could be looking at a potential at least another 10-point jump into the stock price, which should take the stock closer to 70, 72 levels over the very near term.
Okay, and what about your stocks?
So two buy calls which I would suggest at current levels. The first is Policy Bazaar PV Fintech. That stock is looking charged up, trading back towards a breakout on the strong candlestick front. So would look out for targets of 805, stop loss at 740. And Birlasoft is something which I recommended a couple of days back, again showing signs of strength. Very good candlestick pattern today formed for the stock, trading above that 500 mark. So look out for targets of 545, stop loss at 507.
Okay. Avinash Ramesh joins us, Managing Director and CEO with Zaggle. Now, it's a new listing, and post-listing it's done rather well for itself. So, Avinash, how would you describe your company? I mean, the stock has gone up. It's been a lukewarm listing, but a great follow-up. A lot of HNI investors whom markets respect, they bought into your stock now, according to bulk deals. How would you describe your company? I mean, are you a fintech? Are you a extension of HR before giving, different services? What is Zaggle?
Good morning, Nikunj. Thank you so much for having me on the show. Appreciate it. So we are a SaaS fintech. We are at the intersection of SaaS and fintech, digitizing spends to drive growth and unlock value. So it's a combination of software and fintech. The whole idea is that the corporates today, enterprise corporates, mid-market corporates, are really craving for a single platform, single solution with a single login, single payment instrument. The idea is to simplify their life, to bring more transparency, to bring more efficiency, and to make it easier for employees, for users to be able to use the platform.
The one thing that the market is a little concerned about, Avinash, and please address this, that while you are uniquely positioned when it comes to fintech, there is a major dependency on third parties. Do you plan to lower this dependence in the near future?
Third parties that you're possibly referring to our partner banks. Today, we work with a whole host of banks. We just signed up a partnership with Bank of Baroda. We work with Yes Bank, we work with IndusInd Bank. In total, we work with 10 banks, DBS, and ICICI Bank. And what we look at it as a great way of growing the reach, growing the ecosystem. So we are looking to broad base our partnerships with banks, and that's how we view it. It's a symbiotic relationship. We bring tremendous value to the banks through our software platform. As you can see in the Bank of Baroda partnership, for every corporate credit card that the bank issues and the Zaggle Spend Analytics platform is taken by the corporate, we earn a certain percentage of revenue. So, and this is a crying need of corporates. They want a spend analytics platform to go with their corporate credit cards, purchase cards, to understand where the money is being actually spent, why is it being spent, who has approved it, to have that whole 9 yards covered on a single platform. That's what our corporate customers like Tata Steel, Greenply, Aon, Kiran & Group, we work with a whole host of 2,400 plus enterprise and mid-market customers. And that's the need that we are trying to address here.
Christian. So Avinash, who's your nearest competition? Whom would you say you're competing with or competing against in the market?
In India, there is no like-for-like competition if you look at it. But there are pockets where there are companies who compete with us. In different spaces, in employee benefits, we have companies like Sodexo. In expense management, on the pure software side, we see SAP Concur competing with us. There are different players who provide parts of the solution that we provide. In our understanding, there's nobody who has a comprehensive solution for companies where their employee expenses, employee benefits, employee rewards, channel incentives, vendor payments, all of this is covered 360-degree through a platform and a payment instrument.
Avinash, take us through your overall cash flow, because I understand that there's been a total negative cash flow that has been clocked in. How do you plan to stem that plus the decline in your profitability that we've seen in the recent years?
So it's a one-off. If you look at our cash flow last year, overall last 4 years we've been PAT positive, which is a rarity for a fintech and a SaaS fintech company. Our last year, if you look at our numbers, some of those numbers were a little suppressed because we had ESOP costs, which we announced last September. So kicked in last year. And also we invested heavily in building our corporate credit card business. And those expenses were fully expensed out. Those costs were fully expensed out. So what that meant was that we took a little bit of an impact last year. But it was a conscious call to spread wealth to all our employees, and we made it a point to offer ESOPs to every employee who was on our payroll at that time. And it was a conscious call. And the credit card investment also is an investment that we made very clearly to be able to grow the business to the future.
What we have are the declared numbers for FY23. That is like history from a market standpoint, because that's the time you went public. 2 quarters of this calendar year are done for FY24. And the way markets would look at a company like Zaggle, because you're a SaaS fintech company, is that markets will soon start talking about FY25 and FY26. So give us a sense that from 30 crore to 100 crore, how soon you will reach. Where do you think you see yourself in 3 to 4 years? Because that's the way how markets would look at a company like you. FY23, sir, is history now. And nobody likes history. It's about understanding future.
Great point, Nikuj. I think the whole idea is, if you look at where the space is, right, there are 2 very strong secular trends which are helping us. One is that India is at the forefront of fintech, and we benefit from that in a big way. The other is the push to digitize and to be more compliant. So if you look at our platform, let's say an employee travels from Bombay to Delhi, Mumbai to Delhi, and she incurs expenses, flights, food, taxi. All these bills are uploaded on the Zaggle app on the go, and the approvals are given by the approver on the go. And all this information stays on the cloud for many, many years, accessible for any internal audits, external audits, any inquiries, etc. Right. So it really brings in tremendous transparency, prevents leakage, reduces manpower that's required on the accounting finance team side, and that really is a very strong trend across board, and that's something which we really are banking on, and we also see opportunities to take the platform global in the coming years. That's something that's there on in our plans, and we've alluded to that in the RHP as well. So that's where we see the trend of digitization, the trend of reducing leakage, reducing frauds, bringing more transparency is a global phenomenon, and of course India is at the forefront of this.
Okay, fair enough. What about your overall debt equity ratio? What does that stand at currently, and what are the plans to lower it?
See, some of the capital that we've raised is to reduce the debt, and in the coming years, we will look to manage our debt carefully and smartly. You got to appreciate that largely the company over the course of 11, 12 years was built with very little equity capital, and whatever capital was infused, some of it was debt, right, to grow the business. So from a fintech or a SaaS fintech perspective, it's fairly atypical to have such low amount of investment at this scale. And so we have some debt in our books, which we will retire in the course of the future. Right?
So what would be the projected growth for next 3 years, considering if today is the starting point, or if FY24 is the starting point, what could be the next 3 year projected growth according to?
I would refrain from making forward-looking statements here, but if you look at our growth historically, and that's been something with very little capital that we have had so far, you can just take a stab or a guess as to how those numbers will look with the capital that's come in, about 490 crores of primary that's come into the business. So far, very little capital had come in, about $2 million. And that's what we were able to achieve over these years with just that equity capital. So we are very bullish about both our prospects in terms of growth, as well as in terms of what the space we are operating in.
Great to have you on the show. Thanks so much for taking the time out.
Thank you so much for having me.
Okay, that's the word coming in from Zaggle. Let's take a very quick break, but come right back. We've got another discussion with the management lined up on the other side.